Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the last weekly economic review of the month of May. So, covering the week ending May 28, and as usual, joined by our chief economist, Clément Gignac. Good morning, Clément.
Good morning, Sebastian. And as you can notice, I shift my head office to the gazebo just like as last summer. So this is my new environment now. Back
It
to
looks
you.
good. It looks good. It feels good. All right, so I'll start with a look at this week's markets. The close on a Thursday, as you can see, not a lot of red on the screen. So positive returns for bonds on the week, 1.6% for the long index and 0.6% for the universe index. Year to date, still in negative territory. Equities positive across the board. The TSX again leading the way, 1.3% on the week. Although Nasdaq and emerging had very strong weeks again. 1.9% in Canadian dollars when you look at the MSCI emerging index. Year to date, when you bring everything back into Canadian dollars, the TSX is still way ahead of other indices, close to 15% compared to 6.7% for the S&P 500. Oil prices are up 5%. The Canadian dollar flat on the week, euro a bit stronger. The price of gold flirting with the $1,900 threshold again, up 0.81% week to date, and year to date almost flat. So still some interest now, some movement on the price of gold. So COVID, an update on this situation. Canada now we can be proud of the strategy. So at least one dose, that is 53% of the population that has had at least one dose. Now we're going to shift towards the youth, and through the summer months we'll be shifting also towards the second dose. So first, that means that we're catching up. We caught up with the US. We're about to catch up with the UK on the first dose. And on the right, we're still at the bottom of the pack for the population that is fully vaccinated. But through June, July, August, all the way to September, expect Canada to make a strong jump in this chart as we move forward with our strategy. So good strategy there. And also, we also mention often that we like European equities. Well, one of the reasons, even though if we had some negative data from Europe this morning, we learned that France was also in a double dip recession along with Germany and Italy. But when you look forward, seeing lots of progress from their vaccination campaign, strong acceleration, strong confidence. So that leads us to be even more bullish on European equities than we were a few months back. Now, the topic of the hour, of course, is inflation. So we'll focus on that a lot this week. So inflationary pressures are here. The question is it transitory or not? And on the left, I brought the Richmond Fed manufacturing prices paid index. I could have brought 1,000 other kind of charts to show you how tight the supply chain is right now. Prices paid are up, backlogs of order are higher. So we are seeing these inflationary pressures starting to appear. If you go to the grocery store, of course, you see inflation right there. Well, the question on the right, this is one forecast. This is from the Bank of America. So it's their view. They are expecting inflation to core inflation even to be around 3.5 to 4% for the next year, and then fall back to 2.5% range. So they are expecting it to be transitory. So it's transitory a few months, it's transitory a year. It's still up in the air. On our end, we do expect inflationary pressures to maybe surprise a bit more than central banks are expecting. Central banks and the Fed is pretty much as the same story as Bank of America. It should be temporary, and then we'll be back with inflation that is near target. We'll see. It's too early to tell. But if you look at the labor market here, another chart on the left, it is the manufacturing sector's availability of skills needed. So it's a survey. So when it goes lower, that means that businesses are reporting that it's harder and harder to find skilled labor. So this is creating some wage pressures. We're even hearing on the services side of firms like McDonald's that are giving away $50 for anyone who would just show up for an interview. So this is how dire it is in some places in the U.S. Well, it's hard to get labor, but on the right, this is the labor differential index for Conference Board. So again, this is a survey. They call households. They ask questions, and here's the differential between those that say, well, jobs are plentiful, minus those that say say that, well, jobs are hard to get. So usually when the business cycle is strong, you have this index that's high. So jobs are plentiful. So it's easy to find a job. And we're back to the level that we were prior to COVID. So that at the top of the previous cycle. But some people prefer to stay at home and not go work because it's the generous programs that they have. Sometimes it pays more to stay at home and not work. So there's that. And also, some people might be fearful of COVID. Don't want to go work yet. Maybe some people have young children, and it's not clear with the school situation if they can go back to work or if they need to be at home in case the school closes again. So all of these situations are pointing toward labor shortages that could result in wage pressure. So we will be keeping our eyes very intensely on this development through the summer, and this will tell us how transitory or not inflation can be. Shifting to public finances post-COVID, so very interesting contrast of strategies here on the left. Of course, it's not new, but the federal budget that we got about a month ago showed us that, yes, COVID was expensive. So we went from 30 to 35% debt to GDP ratio in Canada to 50%. So a strong jump. It cost a lot of money. And then the Canadian government said, well, we're going to manage the debt to GDP ratio, keep the situation under control, and slowly move lower on the debt to GDP ratio. This is the left chart. Goes all the way to 2026 because Finance Canada gives 5 years ahead the forecast. On the right, we go all the way to 2031. This is in the US. This is their forecast. And yes, COVID cost a lot there too. Debt to GDP ratio went from 75% to 100%. But now today, on Friday, we'll get the proposal from Mr. Biden for his budget. But we got a leak yesterday that he will be presenting a $6 trillion a year spending program, going all the way to 8.3 trillion in 2031, and that will result in an annual deficit for every year all the way to 2031 of $1.3 trillion a year. So that will bring the debt to GDP ratio from about 100% to 117%. And in 2024, we should be reaching the highs of the post-World War II. So a strong left shift for the US. It's not clear, of course, if this will come to fruition. It needs to go through Congress. It needs to go through Senate. But the intention is to have more infrastructure spending, a bigger social safety net in the US. So very different approaches. So if you want another reason for inflationary pressure for the next few years, well, the spending by the US government would be a good argument for that. So that covers the economic part. So now to cover the financial markets, I hand it over to you, Mr. Schneck.
So what a difference what we see in Canada and US. So in Canada, the debt to GDP you illustrate we start to decelerate mostly due to the non-recurrent spending, and US continue to rise. So we will have no problem to have access to more issue on government bonds. And maybe Sebastien, the expression crowding out, you was pretty early. You was much younger, I would say. When we talk about crowding out, it was in the 80s when we have real rates 4, 5, 6% in the 10-year bond yield, and the crowding out was that they have in fact domino effect on corporate sector. The cost of capital for companies were just too high. It was a big handicap for capital spending. So things to watch. Who will follow that? Financial market. Let's start with the stock market and relationship with the Fed action and liquidity. So let's start with the good news that usually we have no bear market until the Fed pull the trigger. Here you have two curve, the interest rate, so you can notice the Fed funds and real rates, and the blue one is the S&P 500. So normally, as long the interest rate not increase, you have no bear market inside. But keep in mind that now with the non-traditional tools that use Federal Reserve, like quantitative easing, if suddenly the Fed start to talk about tapering, just like they have done in 2010, 2011. At that time, that create not a bear market, but a huge correction. So we will see if the Fed will talk about tapering the next meeting in mid-June. Bank of Canada already started the tapering, so they continue to buy purchase government bonds, but at a slower pace. Is it something on the table for mid-June meeting? Is it something on the table at the Jackson after the Jackson Hole Summit in August? But it's coming, but we don't know when. The good news is as long we have a lot of liquidity, no bear market, but stay tuned because we have a lot of frog coming probably down the road. We don't see yet, but no complacency. Sebastian and myself, we keep you updated on that issue in the coming weeks. Next chart, we talk about the valuation, the compare Canada and US. S&P 500 is very expensive compared to other market. On the left side, the twin chart start on the left. You have two curve. The blue one is S&P 500. The red one is TSX. Notice the gap in terms of valuation is very, very significant. So we talk about 22, 23 in US. In Canada, we talk more about the 17. So forward earnings. So it's a huge gap, something we have never seen in the recent history. So for us, make no mistake, if Wall Street going down, Bay Street follow usually, but they can decline much less than Wall Street. And if you are more optimistic about the upside, we have much more upside on Canada than US. Same thing on the right side, we compare TSX emerging market EFI. Notice the PE ratio. So you can notice that it's cheaper, cheaper, cheaper. In fact, the S&P. We think that in addition, it's a game changer what we see currently, and I think we see much more better risk reward with overseas market or TSX market rather than Wall Street. Next chart, we will talk about the again that topic. Notice the purchases, the activity of foreigners. On the left side, you can notice that just like they happened many years ago, now we have more and more foreigners attracted by Canadian market. So significant acceleration of foreign purchases of Canadian equities. This is a good news. That explains as well the strength of Canadian dollar. Partly, there are other reasons as well, but clearly this is interesting. And the right side is the difference of performance between the TSX and the S&P 500. Notice in 2000 when the China joined the WTO, World Trade Organization. It was a boom on commodities. Oil price has shifted beginning 2000 at 30, 35 bucks, finish 2010 at 120 bucks. Canadian dollar was at par at that time, if you remember. So clearly it's different the following decades. You have noticed Canadian equities underperform US equities big time. But now we think we are at the tipping point, and this is a game changer, the COVID-19 and the pandemic. And notice what happened now. The commodities on the boom, inflation, acceleration is much better for TSX than for S&P. This is our message. And this is the strategy that Sebastian and myself adopt in the different managed solution that we take care. Finally, Canadian dollar, maybe US dollar, a little word on that. So on the left side is the US dollar. The dark blue line is US dollar, the DXY, and the other line is the real rates, 2-year bond yield in real terms. Notice it's a huge negative real rates in US. So given the significant debt, the negative real rates, no surprise that the US dollar is under pressure. That's the reason that we have integrate in the diversified funds that we are allowed to have bullion. So we have bullion. I'm staying optimistic regarding the bullion upside in such environment. On the right side is our model on the Canadian dollar that we have already presented in the past. So the red line is the fair value of Canadian dollar, closer to 88 cents, and the current value is around 83 cents. many reasons to be bullish on the Canadian dollar. In fact, notice the public debt Canada US. Canada is much better than US, and the trend is better. Is a declining trend in Canada on the debt, up trend on US. Real rates in Canada are much higher than US. Commodities, and so this is the reason. So even if the Canadian dollar has increased a lot, you can notice on the bottom right of this chart is the gap between the fair value and the current value Canadian dollar. They have still a lot of upside. So we that's the reason that we have implemented hedging in our funds. It's not the first time we have that, but we continue to remain optimistic regarding the trend of Canadian dollar. So I was a little bit too long. We have a lot of thing to watch next week, Sébastien.
Yeah, we sure do. We have a big week coming up. So in Canada, we'll have Q1 GDP growth. We always mention that the US is having a stellar start to its year, when in Canada, we should have 6.5% GDP growth, which should be exactly in line with the US. So good news there. Net change in employment for in April, if you remember, we had the 207,000 jobs lost in the country. We are reopening a bit here at the end of May, but it's all about the timing of the survey. So we'll see if we see an uptick in jobs in Canada. The unemployment rate sits at 8.1%. In the US, we'll have the ISM manufacturing and services indices. We have the unemployment rate at 5.9%, and it's not showing there, but jobs creation also will have the non-farm payroll should be at about 600,000. So we're expecting good numbers again from the US next week. So as usual, ia.ca is your go-to web page. I said ia.ca/economy, I should say. You go to web page for economic news. If it's not done already, you can subscribe to the newsletter. So again, as usual, thank you everyone for being with us on a weekly basis. Thank you, Mr. Gignac, for your insights.
You're very welcome, and I will watch, still continue to watch the hockey over the weekend. That is, the Habs are still alive, and I think for our fan and our friends in Toronto, stay tuned. We will see over the weekend what's going on.
It's gonna be great to see a crowd also watching that game in Montreal. So that's gonna be fun. So thank you everyone, and we'll be back again next week with another edition of the weekly economic review.